Palo Alto Networks, ticker symbol PANW, has just reported its latest quarterly earnings, and the stock has jumped strongly after weeks of volatility and doubt. If you remember, just 2 weeks ago, we covered Palo Alto's massive $25 billion acquisition of CyberArk, which triggered a sharp sell-off. I have been sharing why I think Palo Alto Networks' strong decline makes it one of the best buy now in this bull market. Many investors questioned whether the company overpaid and if growth would stall. Now the market seems to be telling a different story. Let's dive deep into the numbers, the business, and what this means for long-term investors. Before we start, if you're getting value from this video, please subscribe to the channel. We just passed 70 subscribers, so a huge thank you to everyone who's followed the investment diary. First, let's recap Palo Alto Networks as a company. PANW is one of the global leaders in cybersecurity, providing firewalls, cloud security, and AI-driven threat prevention to enterprise customers. The company has been aggressively expanding into zero trust, secure access, and next-generation cloud security solutions. Its customer base includes government, Fortune 500 companies, and mid-sized enterprises, making it a core infrastructure play in the digital economy. Now, on to the earnings. Palo Alto Networks just released its fiscal fourth quarter results for 2025. Revenue came in at $2.2 billion, beating analyst expectations. That's an increase of almost 15% year over year, showing that despite concerns around the CyberArk deal, the company continues to grow at a healthy pace. Earnings per share came in at $1.63, also beating expectations. This beat has restored some investor confidence, pushing the stock higher in after-hours trading. One of the most interesting points from this earnings call is that management raised full-year guidance for fiscal 2026. They now expect revenue growth between 14% and 16% and free cash flow margins to remain above 30%. That is important because even though Palo Alto is spending heavily on acquisitions, it is still generating substantial free cash flow, which gives them flexibility. So, why is the stock bouncing now? The answer is partly psychology. 2 weeks ago, the CyberArk acquisition shocked the market. At $25 billion, it was one of the largest cybersecurity deals in history. Investors feared dilution, integration risks, and overpayment. But the latest earnings show that Palo Alto's core business remains strong, and management has outlined how CyberArk's privileged access management technology will integrate into Palo Alto's broader zero trust strategy. In other words, the long-term story is still intact. Let's break down what makes Palo Alto interesting right now. First, cybersecurity demand is secular, not cyclical. Companies and governments cannot cut back on security spending, especially in a world with increasing cyber attacks, ransomware, and geopolitical risks. Second, Palo Alto has been positioning itself as the dominant platform player. While competitors like CrowdStrike, Zscaler, and Fortinet excel in specific niches, Palo Alto is building a full-stack platform. If they can successfully integrate CyberArk, that would make their moat even wider. Third, the company has strong backing from institutional investors. Some of the world's largest funds, including Fidelity, Vanguard, and BlackRock, continue to hold significant positions. Analysts remain divided on the valuation, but most agree that Palo Alto is one of the highest quality names in the sector. Speaking of valuation, let's talk fair value. Right now, PANW trades at roughly 42 times forward earnings. That's not cheap, especially in a higher interest rate environment. But when you adjust for growth and free cash flow generation, the valuation looks more reasonable. Risks remain. The biggest is execution risk around the CyberArk acquisition. Integrating two large companies is never easy, and cybersecurity firms are particularly vulnerable to cultural clashes and customer churn. Another risk is competition. CrowdStrike and Microsoft continue to invest aggressively in AI-driven cybersecurity solutions. If Palo Alto fails to keep innovating, market share could erode. Finally, valuation risk remains. If growth slows even slightly, the market could punish the stock given its premium multiple. So, what should investors do now? The answer depends on your time horizon. If you are a long-term investor who believes in the secular growth of cybersecurity and Palo Alto's platform approach, the stock remains attractive. The recent earnings show resilience, and management's confidence is encouraging. If you are a short-term trader, you need to be aware of volatility. The stock could continue swinging wildly as integration of CyberArk unfolds. Let's summarize the key takeaways. First, Palo Alto just beat earnings expectations with revenue of $2.2 billion and EPS of $1.63. Second, guidance for fiscal 2026 has been raised, showing confidence from management. Third, the CyberArk acquisition remains a big risk, but also a potential long-term game changer if executed well. Fourth, valuation suggests moderate upside, but investors should expect volatility. In conclusion, Palo Alto Networks has reminded the market that it is still one of the most important companies in cybersecurity. While the stock may not be cheap, quality rarely is. For investors who believe in the digital security megatrend, PANW deserves a spot on the watch list, if not the portfolio. That wraps up today's episode of the Investment Diary. If you enjoyed this analysis, make sure to like and subscribe for more deep dives into the world of investing. Let me know in the comments if you think Palo Alto is worth buying at these levels, or if you prefer competitors like CrowdStrike or Fortinet. As always, this is not financial advice, just educational content to help you make better investing decisions. Thank you for watching, and I'll see you in the next video.